Good morning. How lenders actually underwrite loans and not just what borrowers think. So, most borrowers believe that underwriting is really just about credit score and rate shopping. And it's not. Underwriting is about risk measurement, cash flow stability, and exit probability. So, whether it's a first time home buyer in Katy or a commercial investor refinancing in Houston, lenders use structured financial formulas and not emotion to determine their approvals. So, as a mortgage broker with access to hundreds of lenders through medallion funds, I see both sides. What borrowers think matters, and also what lenders actually calculate. And let's break it down so we can all meet in the middle. Is the point? But let's look at residential underwriting and what really matters there. And when underwriting a residential mortgage, lenders focus on three pillars. And the first being debt to income ratio. So DTI measures how much of your gross monthly income goes towards obligations. And the formula there is your total monthly debt divided by your gross monthly income. And the typical thresholds there are conventional loans are usually 43 to 50% is your max debt to income ratio. Now, with an FHA loan, you can stretch higher with compensating factors. And VA loans offer flexible but still risk based underwriting. So, what borrowers could misunderstand there is that high income alone doesn't fix a high DTI. And new car payments before closing can always kill approvals. And that installment versus revolving debt impacts your credit report differently. And underwriters are analyzing repayment capacity, not just your income level. So, two is income types and how they're calculated. And not all income counts the same. For W 2 borrowers averaged over 2 years, if variable, or there's bonus or commission, we're going to require documented history, 2 years tax returns, usually in that case. But for self employed borrowers, we're looking at net income after deductions. And certain add backs allowed are depreciation and certain expenses. And typically, there's a 2 year average of your overtime, your commissions, your rental income, your alimony, and all those documentation types have different standards, is the point. But the biggest misconception is I made this much last year, so I qualify, right? Well, underwriters qualify based on stable, continuable income and not just your gross deposits. And three is reserves. So reserves after are basically liquid assets that remain after what you need to close. And that's measured in the total months of the mortgage payments. And why reserves matter, there's a lower risk profile. It can be used as a compensating factor to offset higher DTI. There's strong compensating factors as well. But a borrower with 6 to 12 months of reserves often receives stronger approval positioning than one with zero liquidity. So for commercial underwriting, it's all about the asset. And commercial lending flips the script here. Instead of focusing primarily on personal income, lenders focus on property performance. So here are some key metrics that we look out for. And first being is DSCR, or debt service coverage ratio. And that formula is just the net operating income divided by the annual debt service, or your annual loan payments. And typically we'll want to see 1.25 or higher. But for example, if a property produces 130,000 in net operating income and the annual debt payments are 100,000, your DSCR is 1.3. You should be good to go. That means 30% cushion above what your debt payments are. And the lenders don't ask, can you afford it? Because we know you can. They ask, can the property afford itself? Is the real question. Number two is debt yield, and that's the net operating income divided by the loan amount. And this measures the lender's risk independent of the interest rate. So if an NOI is 200,000 and the loan's 2 million, your debt yield is 10%. And a higher debt yield equals a lower lender risk. And bridge lenders often focus heavily on debt yield thresholds. Number three is global cash flow. So for business owners and real estate investors, lenders often analyze both your personal income as well as your business income and your real estate portfolio income and any contingent liabilities you may have. And they combine everything to evaluate your total financial strength. And what this is called global underwriting. To look at everything all together and making sure you can perform. And basically, if one property underperforms, but the borrower's overall financial picture is strong enough, approval can still happen with the right lender. So, why some borrowers could get confused with some of these. And borrowers assume that a high credit score equals a guaranteed approval, or a big income equals an unlimited loan size, or a lower rate is the best deal. But lenders think, is the income stable and is it documented? And does the property cash flow? Or is liquidity adequate? And what is the exit strategy? Underwriting is about probability of repayment is the bigger point. So let's talk about why working with a mortgage broker changes the game for you as a client. So a bank can say yes or no, but a broker is going to ask which underwriting lane fits this borrower best. And in Medallion Funds, that's what we do. We match self employed borrowers with bank statement or alternative income lenders, or investors with DSCR or portfolio lenders, and business owner with global cash flow lenders or SBA products, and credit challenge borrowers. There's also structured bridge options. And the point here is that underwriting isn't a one size fits all strategy. And it's about understanding which lender sees your profile as low risk. So here's a little insider truth on lending. An approval isn't about being perfect. It's really about structuring correctly and positioning your risk properly. But more importantly is choosing the right capital source. And that's the difference between getting denied and getting structured. And if you understand how lenders actually underwrite the loans, you eliminate some guesswork and you start preparing strategically. And really, that's how sophisticated borrowers win in today's market. My name is Bill Rapp. Company's name is Medallion Funds, and website is billrapponline.com. Love to talk to you more. You can figure out how to get a hold of me there. Have a good day.